Welcome back to Road to Fire. We're a family of three documenting our journey to fire, financial independence, retire early. Let's chat about the pros and cons of dollar cost averaging. I will share 3 cons and 3 pros with this type of investing and provide an example with all real numbers like always, so please hang with me. So what type of investor are you? We have always used the DCA method when investing, but should we reevaluate our investing strategy and focus on putting lump sums into the market? Since we started getting aggressive in our fire journey last year, we invest relatively the same amount every month. It's easy and simple for us. But the more I research the DCA method, the more hesitation I have. But don't get me wrong, for long-term investors such as myself, and when I say long-term, I mean holding for at least 1 to 2 years, it does make sense. But as we begin to eliminate more debt and build more streams of income, we will have more money to invest in real estate and stock investments. This has me questioning our current investing strategy. What is dollar cost averaging? Dollar cost averaging, DCA, is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. Essentially, you invest in a fixed amount of money every month no matter what is happening within the market. If the market goes down, you buy. And when the market goes up, you still buy, but your individual share price averages out over time, hence the name. This is an effective, passive, easy, and simple way to invest, and a great way to start automating your savings for the long run. But I won't lie, there are pros and cons to investing using this method. Let me explain. Disclaimer, I'm not a financial advisor, and this video is intended for entertainment purposes only and holds only my friendly thoughts and opinions. But if you're looking to make adjustments to your investments, consult a financial advisor. To effectively explain dollar cost averaging versus lump sum investing, the alternative, here's a hypothetical example I found on the website Clever Go Finance, which is a great resource for all things finance. So say you had $10,000 to invest in the market right now. For lump sum investing, you'd put in the total $10,000 in the first month and are able to buy 200 shares at $50. Now with the DCA method, you still have an initial investment of $10,000, but you invested over 4 months versus all at once. So each month you put in $2,500 and buy at the given share price, which changes month over month. By the end of the 4th month, you would have invested $10,000 with an average price of about $47.50, slightly lower than the buy via lump sum investing. Again, this is a simple example to illustrate the 2 different types of investing concepts, but each strategy comes with its own pros and cons. So here's the number 1 benefit with the DCA method. It helps you avoid timing the market. Now, many professionals claim that they can beat the market by timing their purchases, but the vast majority can't. No one can predict where the market is going at any given time. I've raved about index funds because most index funds outperform fund managers year over year with a few exceptions. Not one person could have predicted 2020 and its impact on the market. Yes, most of us reacted, but many of us were not proactive. Dollar cost averaging prevents you from timing the market. Instead, you'll make regular investments over time and likely outperform the market timers. Keep in mind though, by holding money on the sidelines waiting for the right time, you may miss out on the opportunities and upside gains. By having the multiple recurring contributions, you always have at least some skin in the game. Focus on time in the market versus timing the market. Again, I'm not a financial advisor, but this little piece of advice has helped us build our portfolio over time. I wish we were more aggressive last year when we were investing. Maybe we would have paused our debt-free journey earlier and focused more on investing overall. Maybe we would have seen greater returns. But in hindsight, you can make all these hypothetical scenarios in your head about what investments you would have bought and when. It's easy to do after the fact, but almost impossible to predict ahead of time. But despite all that was happening last year, we did stay the course. We kept investing in our increments month over month, and I'm glad we did. Not going to lie though, it was not fun seeing nearly 33% of our portfolio decline in a few weeks, but we are in this for the long run. Pro number 2, the DCA method reduces risk long term. One of the most important benefits of following the DCA method is the potential to lower your risk over time. Through dollar cost averaging, you'll build out your portfolio at a regular pace. For example, instead of jumping in all at once to time the market, you spread out your investments over a longer period of time. As a result, you can minimize losses and potentially tap into higher returns. In addition, you'll enjoy the benefits of reduced risk in your portfolio. And throughout the course of your investment strategy, you'll potentially, possibly, probably be able to buy more shares at a lower price. Your risk tolerance becomes key here. Number 3 was big for me. The DCA method reduces emotion in investing. I used to have a scarcity mindset, so it was very difficult for me to part ways with money. And it was even harder to really start investing because, after all, investing comes with risk. I mean, investing is putting your hard-earned money at risk. And when we started out, it was very hard to do. But dollar cost averaging can make it easier. The strategy requires you to part with small chunks of money. On an emotional level, it can be easier to invest $2,000 at a time instead of $10,000 at once. This again is all mental, but it does make investing at least easier in the beginning. It also feels like I'm paying just another bill myself, personally, when I do it in increments versus all at once. And to be honest, not everyone has the ability to make large lump sums investments at once, so it really does help to balance things out emotionally. But there are drawbacks to this form of investing. I won't sugarcoat dollar cost averaging at all. After spending some time researching it a bit more, I was beginning to question or at least reevaluate our current strategy. Now, don't get me wrong, we have not shifted anything yet, but I am now running different hypothetical scenarios to see what might be best for us moving forward. I am always looking for ways to optimize our investments, and if there are better paths than our current strategy, I'm all for it. But with anything, the DCA method is far from perfect. It does make sense as a new beginner investor or someone planning out for the long run, but when you actually dive into the numbers and analyze it against lump sum investing, there are clear arguments against it. Now, the number one con to the DCA method is that lump sum investing does give you better returns. To be clear, lump sum investing can often result in better returns because you have your money in the market longer. This is based on the simple idea that the longer you have your money in the market, the better your returns will be over time. Now, hear me out for a second. Vanguard published a study in 2012 that compared lump sum investing with dollar cost averaging. The study looked at 3 different markets: the United States, United Kingdom, and Australia. Here's a link if you want to get into the details. But then they examined 10 years rolling periods from 1926 to 2011, a bit outdated I know, but the rolling periods incremented by month from as little as 6 months to upwards to 3 years. So Vanguard examined over 1,000 10-year rolling periods. It considered different stock and bond allocations. Vanguard found that at the end of the 10-year period, lump sum investing beat dollar cost averaging about 2/3 of the time. The results were consistent across all 3 regions. But, and this is a big but, although lump sum investing outperformed the dollar cost averaging method most of the time, the difference was relatively small. Assuming a 60-40 split in your portfolio in the United States, definitely not our mix, but based on this data, lump sum investing beat out dollar cost averaging after a 10-year period by about 2.3%. Not crazy, but still something to note. Now, number 2 con is not as common now, but increased transactions might lead to increased fees. An obvious problem with dollar cost averaging is that you'll have to make more transactions. And more importantly, the transactions can add up over time quickly. Be mindful of your brokerage account's fee structure when implementing this type of investing. Many brokerage accounts now have 0 or low fees, but make sure you take the time to understand all the fine details. We use Vanguard and Robinhood, and both accounts do not charge us for fees, no matter how small or large our transactions are. The last con is having to rebalance and asset allocation. As you invest, you need to spend time reassessing your asset allocation. Essentially, that means that you need to make sure that your investments continuously reflect your goals and risk tolerance. Your mix can potentially get out of whack with dollar cost averaging. We review our asset allocations annually, but Vanguard does a great job highlighting our mix every time I log in, which keeps this top of mind for me. But because the DCA method is automatic, it's easy to forget to review your portfolio mix or allocation. Make a habit of checking back in at least annually. This is what we do personally. Now, we have no plans to change our strategy yet, but I do think we might front load our IRAs moving forward. Because we treat savings and investing like paying bills, it would be nice to have one less line item to manage during the year in our budget. To be able to do this, we'll need to plan ahead. But because we are budgeting month to month, we would really need to be a bit more strategic. I think it's possible, but this does take some effort on my end. I will note that front-loading your 401k is not advised. As I learned by this great community, you may miss out on your company's match unless you plan on switching jobs. But I'm curious to know, do you use the DCA method or are you a lump sum investor? Comment below and let me know. Now, if you made it this far, thank you so much for watching. But don't forget to like, comment, and subscribe below. Until next time.